Well, welcome and thank you all for taking the time to be with us this morning. Some housekeeping items first. The webinar is being recorded and a copy of it will be sent to clients shortly after. As it's normally the case, we have a lot to unpack this morning and only have about 30 minutes together, so we will not be taking questions during the webinar, but if you have questions, please reach out to your relationship manager or any of us on the call today. If you have already submitted a question to us using the Ask a Question button in the invite you received, we thank you and we'll do our very best to answer it during the webinar today. Okay, so let me first introduce my colleagues, Steve Brudos and Brandon Hellenbrand. Steve and Brandon are portfolio managers and have both been with the firm for over 10 years. Steve specializes in fixed income markets, while Brandon specializes in equity markets. Along with the rest of the investment team here at TrustPoint, Steve and Brandon are key contributors to the research process and the ongoing management and monitoring of clients' portfolios. So Steve, Brandon, welcome, and thank you for being here this morning. I would like to start a conversation this morning by first addressing the banking events that unfolded over the past 6 weeks or so. But before I do that, Steve, I think we should really spend maybe a minute or two discussing the root cause of the banking stress, the reasons we have seen bank failures here in the US and in Europe over the last few weeks. And the root cause would be rising interest rates. So what can you tell us on that?
Sure, thanks, Jan. We've been in a rising interest rate environment for over a year now. We do believe that the end is in sight and we're likely, nearing the peak of this rate hike cycle. But the Federal Reserve and other central banks, around the world have really been raising interest rates with the ultimate goal of slowing down inflation. And inflation has been too high for going on a couple of years now. So in the US, as this chart illustrates, the red line is the current rate hike cycle. So the bottom axis indicates the number of days, and it shows that this is really the second most aggressive hiking cycle in history when we consider the pace of rate hikes. So only the very high and persistent inflationary environment that we had back in the 1980s really led to a faster pace of rate hikes, and that's indicated by the blue line. So, it's this impact of really tighter monetary policy from our central banks, which has caused a rapid adjustment higher in interest rates. And that is now being felt, throughout multiple areas of the economy. And, the first domino to fall was the speculative areas of the market. You had cryptocurrencies, stay-at-home tech stocks, and then the second domino was real estate. Mortgage rates rose from 3 to 7%. They're back down a bit now, but home affordability really weakened and the appreciation in real estate prices has really cooled off. So we'll get into the details in a bit, but it's this rapidly rising rates more recently contributed also to the collapse of Silicon Valley Bank, Signature Bank in the US, as well as Credit Suisse over in Europe.
Yeah, it's pretty clear, and I think you gave some good examples of that, Steve. It's pretty clear that rising interest rates are starting to bite here. And I would even take this a step further and go as far as to say that periods of rising interest rates usually don't end up well. And I think the chart here illustrates that. Periods of rising interest rates have often led to, let's call them financial accidents. When the Fed tightens monetary policy, something usually eventually breaks. In the late 90s, as we can see here, it was long-term capital management, LTCM, a large hedge fund that really blew up due to large levered bets. In 2000, 2001, the tech telecom bubble imploded as higher interest rates led to a collapse in equity valuations. And more recently, we all remember 2007, 2008, it was the subprime crisis. The housing market fell hard under the weight of higher interest rates. So the collapse of Silicon Valley Bank and Signature Bank, as you alluded to, Steve, is in a sense the first noticeable financial accident from the rapid rise in interest rates we've seen over the past 12 months or so. Now, as the chart here shows, Silicon Valley Bank and Signature Bank were somewhat unique in the sense that they were both highly dependent on uninsured depositors for funding, meaning that a large proportion of the deposits were above the 250,000 FDIC limit. In fact, now as the chart here shows, almost 90% of the deposits were above the FDIC limit. And a lot of these deposits were also held by corporations, not retail customers, but corporations. So what happened is shortly after Silicon Valley Bank announced on March 8th that it was raising additional capital, many corporate CFOs really panicked. And what followed was a classic run on the bank in which corporate depositors attempted to withdraw their money very quickly. As we all know today, Silicon Valley Bank was ultimately unable to raise the funds quickly enough to pay back its depositors, so the authorities had to step in and seize the bank. Now, even if the circumstances around the failure of Silicon Valley Bank and Signature Bank were somewhat unique, they, again, in our opinion, represent the first noticeable casualty of rising interest rates. Steve, I know you have a slide in here to explain how rising interest rates directly and negatively impacted the ability of these two banks to survive. But before we cover it, let me first address the question we received from clients. And the question is, will we see more bank failures? And if so, is my money at risk? And the answer to that would be yes and no. And let me explain what I mean by that. As the chart here shows, bank failures are, first of all, not uncommon. They picked up during the savings and loan crisis in the late 80s, and also during the Great Recession of 2008, 2009. So more bank failures would not surprise us. So we would say yes to that question. More bank failures are likely. Should we experience more bank failures, will depositors be hurt? That's the second part of the question. And our answer to that would be no. No, the depositors were certainly not hurt in the case of Silicon Valley Bank and Signature Bank, as we know, the Department of Treasury, the Federal Reserve, and the FDIC really stepped in to fully protect depositors, regardless of the size of their balances at these two banks. So if needed, no, we believe that the authorities would step in again and do the same thing, and again, make sure depositors are protected. Having said that, I think it's important to mention that we continue to believe that it's always prudent to keep no more than 250,000 per depositor, per insured bank, just in case. So Steve, let's review maybe your chart next here, which I think provides a good illustration as to why we may ultimately see more bank failures in the future, and why interest rates, again, were the main factor in the failure of Silicon Valley Bank and Signature Bank.
Yeah, thanks, Jan. If you just want to move to the next chart here, and just focusing on the top panel first, it shows the Fed funds rate, which has risen from 0% to almost 5%. And it shows that relative to bank deposit rates. And you can see that a very wide gap has developed here. And on the bottom panel of this chart is the Fed funds rate relative to money market rates, which are indicated in blue. And money market rates have done a much better job keeping pace with the Fed funds rate and are up to 4% or higher. At the same time, while bank deposit rates have barely budged and are still well below 1%. Our money market, for instance, is yielding close to 5%. So Silicon Valley, Signature, and Credit Suisse Bank, they all three had their own specific issues, but rising rates was somewhat of the underlying problem. It caused a lot of unrealized losses on the bank's bond portfolio. And at the same time, and maybe more importantly, it pushed a lot of depositors at a historic pace, out of banks and into these higher yielding money market funds. So it was that those rapid outflows of deposits that the banks were unable to fully absorb, and the banks were required to sell securities at deep losses, which caused more capital and credit concerns at the same time. And that really resulted in the run on the bank that Jan had mentioned earlier. The outflows of deposits has slowed a bit, but if we go to the next slide, we'll try to answer the question of, what might this mean more broadly for other banks and for credit conditions? And really, even before, the recent bank failures, banks were already starting to tighten lending standards. And that's shown in the black line on this chart. You can really see it has moved substantially lower, and bank lending standards are likely to become even more stringent now after we've seen such, substantial deposit outflows, and we're likely to see more bank regulation, which is likely to come. That's important because lending conditions tend to lead loan growth, which is in green in the chart, by about a year. And this has also been a good leading indicator of a recession, noted by the shaded areas on the chart. So we do expect that green line or loan growth to really continue to come down. And the result is that, less lending, less loan growth is going to add to what the Fed is doing with its rate hikes. So ultimately, further tightening of financial conditions is going to continue to kind of constrain economic activity. And, the first signs of credit tightness are starting to appear. You have bond defaults starting to pick up. Bank non-performing loans are starting to increase. And really the underlying quality of loan books is starting to weaken a bit. And this is all typical during periods of economic weakness. And that outlook is supportive of our cautious stance on credit in portfolios and corporate bonds in general, and really also contributes to our broader economic outlook, which I'll turn it back over to you, Jan, to cover in more detail.
Yes, so as Steve just said, the combination of higher interest rates and tightening lending standards, we believe will lead to more economic weakness. Our global economic model, which is represented on the chart here by the dotted line, shows that between now and March of next year, which is as far as the model can go, the global economy is very likely to slow down. So we believe the global economy will get worse before it eventually gets better. Now, we've got a lot of questions on the potential severity of an economic slowdown. Maybe before I answer that question, let me first explain what you're looking at here and the difference really between what economists refer to as soft landing, which would be in blue, and versus hard landing in orange. The soft landing is essentially a slowdown in economic growth that avoids a recession. So historically, soft landings have been associated with mild rate hikes, low inflation, and still relatively easy lending standards. So no need to say that this is not our base case scenario. However, if you look at the past few decades, 1994, 95, and 2017 and 18 are the last two periods really fitting the soft landing scenario. Today, again, as Steve mentioned, not only do we have the second most aggressive tightening cycle in history, but inflation, as we all know, has been sticky, high and sticky, and lending standards are tightening. And as Steve explained, are expected to get even tighter in the months and quarters ahead. And historically, that has been a recipe for a hard landing, the slowdown in economic growth associated with the recession. So a recession remains our base case scenario with the start date in late 2023 or early 2024. Having said that, we don't expect a deep hard landing, and I think that's very important to mention. We don't expect another 08-09 type of recession, but more of a shallow recession. Even if it turns out to be only a shallow recession, we do believe, however, that investors need to be prepared and need to position portfolios accordingly. So I'll now ask Brandon to share some insights on earnings and how we are positioning equity portfolios based on our macro outlook.
All right, thanks, John. Yeah, before I get into the portfolio positioning, let's go over earnings. So over the last 2 years, strong consumer spending combined with the high inflation has boosted corporate revenues and increased earnings. Now, high interest rates, tighter lending standards, and a weakening economic outlook are having negative impacts on corporate profitability. So as you can see in the next chart, global earnings, as measured here by the annual change in earnings per share, or EPS, have now declined relative to levels 12 months ago. Equity investors pay close attention to corporate earnings as it's a major factor in determining what the fair value of the price is. So any further declines in earnings could result in investors reducing the value that they see for companies and result in lower stock prices. So as a result, we are paying close attention to the direction of earnings from here. And as the next chart will show, we'll give you an indication of where we think that might be heading. So what's concerning to us is that earnings are likely to decline further, as indicated here by the beige line. This line is a model that's using various economic inputs to predict that future path of earnings. Equally worrisome is the fact that current analyst expectations, as indicated here by the dashed green line, are still expecting positive earnings growth over the next 12 months. We would expect analysts to revise their estimates lower to reflect the economic realities, and as a result, we would expect investors to reprice stocks lower as well. So although this creates downside risk for the overall market, certain equities are less impacted by slowing economic conditions. To illustrate this point, the next chart is showing how changes in ISM manufacturing, which is a proxy for economic growth and shown here in the dark blue line, impacts the returns of cyclical stocks relative to defensive stocks. Examples of cyclical stocks include energy and material companies, banks, and consumer discretionary. These companies typically see their revenues and earnings decline the most during periods of economic weakness. On the opposite end, defensive stocks include companies like utilities, healthcare, and consumer staples. Revenues and earnings from these companies tend to be less impacted by changing economic conditions. So as a result, we have shifted client portfolios away from those cyclical sectors and in favor of the defensive sectors as we anticipate economic weakness to continue. In addition to specific sector allocations, other factors tend to outperform during economic slowdown and recessionary environments. So as illustrated in the next chart, when outlooks for earnings are uncertain and the outlook for the economy is uncertain, investors typically prefer high quality companies with reliable and predictable earnings and strong balance sheets. The stock prices of these companies tend to be less volatile and therefore reduce overall volatility. So the combination of these two factors is another way for equity investors to reduce their exposures to risk. So client portfolios are currently positively exposed to both of these factors as we anticipate the economic slowdown or recessionary environments coming forward. So now I'd like to turn it back over to Steve to talk about the outlook for bonds.
Yeah, thanks, Brandon. If you want to go to the next slide, rates were extraordinarily low for a really long time, right? Global central banks kept rates low and even went into negative territory coming out of the 2008-2009 financial crisis. So we're currently in the later stages of this tightening cycle, and there is a silver lining, so to speak. Bonds have really become a compelling component to portfolios, with the current environment offering the highest yields in 10 to 15 years out of really high quality safe haven bonds. And historically, as this chart illustrates, there has really been a strong correlation between the starting yield on a bond and future returns. So this is essentially showing and saying that the higher the starting yield, the higher the future 10-year return. So with interest rate normalization that we've seen and yields at the highest levels in over a decade, income has again become a meaningful component of return. And it's because of this income component that bonds are likely to provide forward-looking returns that really we haven't seen in quite some time. And in addition, we've talked about recession, right? If recession risks do continue to increase, core bonds could rally due to their safe haven status. This is because typically, during recessionary environments, money tends to flow out of equities and into, high quality fixed income. So it's really against this backdrop that there, currently is a wider range of scenarios that really can lead to, positive returns for fixed income. So in our view, the asset class has become much more compelling and is likely to provide a lot more downside protection than fixed income offered back in 2022.
Well, thank you, Steve and Brandon, for your insights. That was very helpful. As Steve mentioned, we are in the later stages of the tightening cycle, but because of the lag effect of interest rates on the economy, now we expect economic activity to continue to weaken in the months and quarters ahead. The HOPE or HOPE framework presented here is, we believe, a good roadmap ahead. As Steve discussed, housing or real estate was first impacted by rising interest rates. Orders have been weakening. And as Brandon just discussed, we expect production and profits to be the next shoe to drop. Employment is a lagging indicator. So at this point, we don't expect much weakness in the employment market in 2023, but we believe 2024 could look a lot different. So what does that all mean? From a portfolio positioning standpoint, that means defense first, right? In our opinion, this is not the time to be aggressive. For us and our clients, that means favoring bonds over stocks. And within stocks, we would favor value defensive sectors and companies over cyclicals, and also favor value defensive sectors and companies over the more growth-oriented segments of the market. In our opinion, it is very important to own real companies with real earnings in what we believe will be a more difficult economic environment ahead. We also favor domestic stocks over international stocks, as US equity markets are generally a safe haven during periods of economic weakness. Within fixed income, we remain, as Steve mentioned, cautious on credit, as credit event risks are still underpriced, in our opinion. We are, however, more constructive on interest rate risk. Now, we believe high quality, short-term bonds, for example, will provide a really good risk-return trade-off right now. But we also think that will come a time when taking a little bit more interest rate risk or duration risk will make sense. So we think we'll be given that opportunity in the months to come. As recession fear continues to grow and we see continued inflation coming down. And here again, we favor domestic bonds over international developed or foreign bonds. While I will say we are certainly encouraged by the performance of both equity and fixed income markets year to date, both markets are up year to date, our focus at this point remains on really identifying safe haven investment opportunities as we go through what we believe will be some economic turbulence in the months and quarters ahead. Okay, so I'm looking at the clock here. We are close to the 30-minute mark. So we will conclude the presentation here. Steve and Brandon, again, I want to thank you for your insights. And to all of our clients on the line today, thank you all again for attending the webinar. We will see you next time.